Did you know that Canadian real estate sellers canceled over 1 in 5 listings in July, reaching a record volume? This trend is part of a broader strategy to limit downward pressure on prices, but it also raises questions about the future of the market. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, MacKay. Let's get right to it. This week, we're diving into some significant stories that have been making waves in the Canadian real estate market. According to Better Dwelling, Canadian real estate sellers canceled about 22.5% of listings in July. This high cancellation rate is reminiscent of the record high set back in 2022 during the low-rate speculative boom. While canceling and relisting later might help create a stronger demand balance, it also risks relistings into an environment with higher inventory, as near-record completions are now hitting the market. Shifting our focus to the broader economic context, the Canadian economy has hit a rough patch. The real GDP contracted by 0.4% on a seasonally adjusted annual rate in the second quarter. This contraction was driven by falling exports, weak business investments, and a decline in non-residential construction, according to Better Dwelling. The silver lining here is that household and government consumption prevented a deeper contraction, although this was largely supported by dipping into savings and increased reliance on credit. Another significant story is the capital flight crisis. The second quarter saw foreign investors pulling $16.8 billion out of Canadian securities, marking the largest divestment since 2007. Additionally, domestic firms spent $26.8 billion abroad, significantly increasing outflows as inflows from foreign direct investment collapsed by 39%. Portfolio investments saw a net outflow of $43.7 billion, reflecting a diminished confidence in Canada's growth prospects compared to opportunities abroad. Interestingly, Canada is seeing a shift in work dynamics as well. The number of remote workers has decreased by 790,000 since 2022, with the share of remote workers falling from 22.4% to 17.4% of the workforce. This shift is part of a policy effort to anchor workers to major cities, reviving downtown cores that were hollowed out during the pandemic. As more workers are commuting, this could have implications for multifamily real estate, especially in urban centers like Hamilton, Kitchener-Waterloo, and London. Lastly, we need to touch on the issue of mortgage debt. Canadian household mortgage debt topped $2.3 trillion in June. While rising credit consumption typically signals economic growth, the current picture suggests otherwise. The increase in mortgage debt seems to be a follow-up to the pre-construction boom from 2020 to 2022, as those homes are now completed, requiring buyers to secure financing. It's a reminder that what seems like growth can sometimes just be the bill from the last boom arriving. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, MacKay. See you on the next one.